Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Rosser, Victory Fiduciary, and we have a lot to get in today. So what I'd like to do is kind of start off macro with what's going on, fundamentally, specifically within the market landscape. I want to talk a little bit about just kind of the current banking situation, and I've gotten a lot of questions about the Silicon Valley Bank situation, followed up with the Signature Bank collapse in early March. Kind of talk a little bit about what kind of led to these two specific regional banks collapsing, and why we think that, generally speaking, though, our banking system remains very strong. And so let's kind of get right into that. So Silicon Valley, very interesting philosophy. So 44% of their clients were kind of venture-backed in technology and healthcare, innovative technology. So a very kind of specific niche of customers that they were servicing. And so Silicon Valley did some interesting thing with fixed income, and they had a lot of longer duration bonds, which, if you'll remember, if you've been attending our videos, longer duration bonds have not done well in this rising interest rate market. Why? Because if you have a bond that you purchased 6 months ago, now rates are higher, you can get a better yield with a shorter term bond in the future. And so they had a lot of pretty prolonged fixed income investments. Some of these technology clients had taken some hits, especially kind of from the beginning of the year. They needed to withdraw more capital. And so what happened was Silicon Valley was having trouble meeting all of the liquidity requirements of its customers. And so they announced that they were going to have to sell a lot of common and preferred stock to try and raise about $2.25 billion. That's because they had sold at a loss about $1.8 billion, some of their fixed income portfolio, trying to kind of make good on what their technology clients were kind of coming to withdraw. And so there was then a run on the bank. So once they announced that they were going to have to raise additional capital with common stock, people panicked. Everybody wanted to withdraw their money. They had trouble meeting the liquidity requirements of what was being withdrawn. And then so that was kind of then, that the federal government did step in. And so at the same time, or very shortly after, Signature Bank, which again is a very specialized, interesting regional bank that did some, I'll say, strange things, had a lot of focus on cryptocurrencies and uninsured deposits. Okay, so that really could have been setting up for the perfect storm. And so a lot of their clients also kind of panicked at the same time as this was happening. And so we saw Signature Bank wound up closing very shortly after Silicon Valley. Now, could there be some additional contamination into some regional banks? Sure, there could. But I think, generally speaking, when we look at what happened with both of these specific areas, these were pretty, I would say, out of the norm in terms of how they operated and what they were holding in terms of capital and those things. So while markets definitely responded and reacted accordingly in the short term, I think that, generally speaking, our banking institution kind of remains sound. But again, this was a very interesting thing to see two banks like this fail in a very short time. And so kind of moving into the next area and what we're going to be looking for today, Federal Reserve going to be coming out and speaking on whether or not we're going to be raising rates this additional 25 basis points. And so markets have kind of already priced this in. I think I'll be surprised if the Federal Reserve does not opt to increase by this 25 basis points, like kind of what we're expecting. Inflation continues to be a really sticky situation. And so we saw the CPI numbers that came in from January to February. When we look at year-over-year numbers, CPI came down from 6.4 to 6, which on the surface looks like, hey, great, inflation came down, although that includes areas like energy and food prices, which has kind of come down dramatically. And so when we look at the U.S. core CPI, and so this is going to include all of the other areas except for food and except for energy, so healthcare, airlines, everything kind of combined, rate of inflation was 5.55 in January, and that only came down to 5.53 in February, which kind of gives us a macro picture of the fact that if you take away food prices and energy prices, we're really still dealing with some sticky points of inflation. And so I think the Federal Reserve, it'll surprise me if we don't see another rate hike. Now, I don't think markets are going to react too much to if they say that we are raising these rates, because of the fact that's kind of already been priced in. I'm looking for what their forward-looking guidance is going to be in terms of, do they believe that we are done and we may even begin to see rate hike or rate decreases in the next 6 months to a year, kind of what their long-term thought process is. So we'll be looking for that. I don't expect a ton of surprises in terms of what they come out and say today. So that's just kind of a snapshot on, again, kind of what we saw happening with these two banking collapses. I've got a lot of calls. I think there was a lot of overreaction and fear selling that kind of resulted as people were thinking this is a repeat of 2008, which these are very, very different situations from what happened in the beginning of March and what happened in 2008. So just to kind of give you an idea about where we are with markets, here's the S&P 500 looking back 1 year. So as you remember, our 200-day moving average, we had closed up above here. Now, after everything kind of happened with the financial changes and that we saw at the beginning of March, we saw a lot of selling. Although now we've reclaimed above that 200-day moving average, and we're actually very close. Today we could do it, depending upon some of the action, closing above the 50-day moving average. These are two bullish, encouraging indicators that we look at. We've also really been in an upward trend ever since then. So RSI is only at 52, so there's a little more room for there to run there. So I would say, you know, things are looking encouraging. I think especially if the Federal Reserve comes in and is able to say they're going to be a little less aggressive moving forward. Again, I don't know what they're going to do with that U.S. core CPI number being as sticky as it was, even though CPI numbers had come down nicely. So, but when we look back kind of from beginning of the year to now, we've really had, as you can see, you know, a nice run, but a lot of volatility, a lot of choppiness in terms of trading. So just, we're going to have to keep an eye. Now, QQQ, this is kind of our tech heavy index. This one has really seen since January, we've seen a really nice return here, and we are well above our 50 and our 200-day moving averages. That just kind of goes to show when you look at areas of the market that have seen strength, and then again, QQQ didn't have a whole lot of holdings in banks and financial institutions the way that the S&P 500 would have. So now our RSI here is 63. That's getting really close to that 70 point. And we know that typically when we hit 70 or higher, we expect at least a temporary cooling off or pullback. But again, in terms of, you know, market movements, S&P 500 has had modest gains, just very, very slight gains. QQQ is up like 16% year to date. So that just kind of goes to show that it really does depend upon what area of the market you have exposure to. It's really important to have that plan in place. And so I will say, I've been talking to a lot of clients, and so, you know, value versus growth. So we've seen growth, QQQ would be an example of a growth area, has really kind of taken off this year, and then value has been a little slower. So those value names are those areas of quality. So they may not have, you know, huge double-digit positive returns every year, but you typically tend to see, you know, them paying dividends. They tend to be over time just good, solid companies, not maybe as innovative where we see these, you know, 20 and 30% returns in 1 year. And so we've seen value lag this year and growth, which last year, if you remember, it was the opposite. Value was kind of areas of strength where growth definitely lagged all year. And so we've kind of begun to see this change. And so the question is, have we seen a true trend reversal? And so is value now cooling off for the long term and we're going to see growth take off? Or is this just kind of like a fad trade that we've been seeing? And that has kind of remained to be seen, because I think that there's a case for both. I think what the Federal Reserve has to say about inflation will kind of give us a little more insight. Value tends to do much better in times of high inflation. because those areas of value typically also tend to be areas that are do well because people need them no matter what. You're still going to go to CVS and you're still going to buy your toilet paper and you're still going to buy the medications that you need. So you're still going to buy gas at the fuel pump. So these areas of value versus innovative growth get really hit hard typically in times of high inflation. Cost of money, purchasing power it's higher. It costs more to borrow money. Everything that you do just costs more. That goes right to your bottom line. And so we're kind of seeing this power struggle now, and so it'll be interesting to see in the coming months kind of who the leader emerges to be. We're watching both areas very carefully. We actually, in our portfolios right now, we have exposure to both. So we do have exposure to growth. We also have exposure to some value areas. So areas like consumer staples would be an area that we have exposure to. And so watching, and again, we've seen kind of these like cycle changes moving very quickly, and so it's important. You always kind of want to wait and make sure that trends confirm before you make kind of major final decisions in your portfolio. And again, I think what the Federal Reserve has to say about inflation and kind of what their forward-looking guidance looks like is going to be a pretty important key, both today and probably in the next month or two. And then, let's see. So, what I wanted to do, we haven't done this in a little while, when we look at dynamic asset level investing, kind of where are the what's doing. So again, international kind of jumped to the #1 spot about 2 months ago, although we've seen some weakening in other areas that we track. So just kind of something to keep in mind. Cash is in the #2 position, and it's interesting. So the 7-day yield in a money market fund that we hold right now is up 4.56% for 7 days. So just to kind of show, and that all kind of just comes back to these interest rates that we're seeing that are, in some cases, like historically we've seen increases in them. And so I just thought that was an interesting point to bring up. So cash is actually in the #2 position. Domestic equities is in the 3rd. And so mid-cap value, mid-cap blend, small-cap value are in the 1, 2, and 3 position. So even though we saw how QQQ, which is up 16% year to date, when we see actual areas of kind of strength and cash flow moving in, we're still seeing value kind of remain leadership. And so that's this tug of war that we're talking about, that looking at the technicals and the fundamentals together, there's a little bit of a disconnect. So it's going to be interesting to see which leadership actually winds up prevailing over that. And so looking at sector leadership, basic materials, industrial, consumer, non-cyclical. So this would kind of be the opposite of staples. These would be non-cyclical, are things that we don't have to buy, but that we want to. And so that's kind of a newer leadership that we're seeing. So again, we're waiting to see if that kind of leads true. That tends to go with a growth rotation. So we'll watch that. Financials, which had been in that top 3 for probably 2 years now, we've obviously seen some weakening. So we're going to have to wait and see if that holds, or if that winds up kind of recovering as we get further away from these 2 banking collapses that we've seen. And technology has been also on the rise as well, and healthcare. So, and again, healthcare and technology are kind of like opposites. Healthcare is typically considered more of a value play, and technology would be a growth play. And so we're seeing increasing strength from both of these. Again, interesting because they're kind of like opposites when we look at the type of names that they are. So it's an interesting time. So we're certainly we're spending a lot of time kind of researching, keeping an eye on trends, keeping an eye on areas of rotation to kind of see where this all shakes out. And again, I think that the biggest thing here is inflation and kind of what is going to kind of shake out. Where is the Federal Reserve's end game here? Because we've seen a very aggressive rate hike program since last year. And so we're really waiting to kind of hear what their forward-looking guidance is. Are we at the end line? Because I think that when we get to that end zone where we're finished, that's really going to probably give markets some room to run. But they really can't do that until inflation is truly under control, because if they stop too soon, we could be right back to where we were a year from now. And so, end of quarter. Here we go. So I just wanted to get my contact information up there again. You know, we get a lot of questions, and so obviously when we have situations like what happened early March with Silicon Valley Bank and that collapse, that tends to get people's attention, and so suddenly they're kind of looking at their portfolio maybe a little closer than they had been looking at it before. And so if you have questions about your current allocations, how your portfolio is constructed, we use a rules-based approach to investing, and so it's non-emotional, kind of allows us to kind of set our rules ahead of time, and then we just kind of follow them as they're triggered. And so if you have questions, we're always happy to discuss them with you, help make sure that you have a prudent investment process in place. And as fiduciaries, we take that very seriously, so you can always reach out to me by email or by phone with questions. We thank you so much for tuning in today. We'll be back in 2 weeks with another market update. Have a great day.